When I was 10 years old, I bought my first few shares of dividend-paying stocks. I was visiting my grandparents in the summer of 2006 and had some extra cash burning a hole in my pocket from my allowance, but I had no idea what to do. Ultimately, I bought Pfizer and Southern Company, two businesses that were around long before I was alive and have thrived in the time since. I bought the shares under the direction of my grandpa, who at the time was in his mid-60s and almost 20 years retired. Today, I'm earning 142% and 89% yield on these investments. How did this happen? I was learning a valuable lesson and I didn't even know it. But today I understand how such a small investment can balloon into a formidable income stream. The one point my grandpa drilled into my head was to reinvest dividends. Always reinvest dividends. We'll see exactly why this is so important later in the video. At 10 years old, I didn't even understand what a dividend was, but I knew my grandpa knew more than me, so I listened, and I'm glad I did. In this video, I'm going to walk you through exactly how I earned such high yields on investments made over a decade ago and how you can too. It's all in the power of dividend compounding. The most important point to consider is the difference between initial yield and yield on cost. The initial yield is the dividend amount divided by the share price at the time you purchase the shares. If a stock is paying $10 per share and the price is $100 per share, the initial yield is 10%. Simple stuff. Yield on cost is mostly the same with a subtle but very important difference. Yield on cost is calculated by dividing the current dividend amount by the cost basis. So what does this mean? This means if you purchase a stock at a certain price and the dividend grows while you hold the stock, you earn a higher dividend yield over time. In our previous example, let's say the dividend doubles over 10 years to $20 per share. Since you bought the stock at $100 per share, however, your yield on cost is now 20%. Keep in mind this is without any dividend reinvestment and a very modest dividend growth rate. A dividend can double over 10 years with an annual growth rate of only 7.2%, and I've seen 10-year growth rates well above that very recently. Dividend growth is critical to earning unfair yields in the marketplace, so let's take a closer look. Dividend growth contributes to your yield on cost. You bought shares of a stock at a certain price, and that company only pays you for the number of shares you own, not how much your position is worth if you sell. As long as you hold on to your shares and the dividend continues to grow, it doesn't matter what's happening to the share price. In fact, later in the video I'll show you why a declining share price is oftentimes more desirable than an increasing one. Dividend growth is the percent increase in the dividend amount per share over a given time period. If a company increases its dividend from $10 per share to $11 per share over 1 year, the 1-year dividend growth rate is 10%. Calculating dividend growth over many years is a little trickier, but fortunately there are many growth rate calculators online that can quickly give you an average annual growth, compounded annual growth rate, average rate of return, and many others. I tend to stick with compounded annual growth since it's the type typically used in forecasting. So why is dividend growth so important? Very small changes in the dividend growth rate can have outsized impacts on your yield on cost. Let's take a look at a $1,000 investment with an annual dividend growth rate of 7%, an initial yield of 5%, and 3% share price appreciation. After 20 years, our yield on cost is 57.92%. Not bad. If we hold all other variables the same but increase the dividend growth rate to just 8.5%, our yield on cost after 20 years is a whopping 90.8%. That's with just a 1.5% increase in the growth rate. Without dividend growth, the snowball never gets rolling and dividend investing just isn't worth it. Dividend-paying stocks don't typically see massive share price appreciation. The passive income potential is really what's attractive to most dividend investors. Dividend growth is like torque in a sports car. The higher it is, the faster you can jump off the line. Initial yield then is a lot like your starting speed. If your car is already moving, it's much easier to beat a car standing still. Initial yields can vary widely for a company throughout the year since the yield changes in proportion to the market price. For instance, Johnson & Johnson, considered by many to be the gold standard in dividend investing, has had a 52-week high of $182.97 and a low of $150.11. With their current dividend per share of $4.76, J&J's dividend yield swung between 3.2% on the high end and 2.6% on the low end over the past year. In our example, a small change in initial yield from 5% to 4% drops our yield on cost after 20 years from 90.8% to 55.5%. This is why it's so critical to find high-quality dividend-paying companies at low prices and pass up on stocks if they're too expensive. One thing we do on this channel is identify stocks that are trading lower than they should be and have historically high yields. Every week there are at least a few stocks that present huge opportunities to maximize your yield on cost, so make sure you subscribe and turn on notifications to see each of these opportunities as they arise. One thing to note in this example is the fact that during those 20 years, all dividends were being reinvested. I mentioned it at the beginning of this video, but this is the single most important point my grandpa drilled into my head, and I can't stress enough how crucial this is to your financial future. Dividend reinvestment allows you to pick up additional shares of stock at no additional cost. Your initial investment remains the same, but your total share count increases automatically. As the dividend grows and your shares increase, drip investing allows you to purchase potentially thousands of shares every quarter. If we take our previous example and turn drip investing off, our yield on cost drops from 90.8% to only 24.77%. I mentioned earlier how a declining share price can actually be more beneficial for dividend investors than an increasing one. That's because as the share price drops, the number of shares you're able to buy with your dividend increases. So long as the dividend doesn't get cut, this means more income growth every quarter. If our stock has an average annual share price drop of 3% per year, after 20 years our yield on cost is a massive 201.35%. If you can, always keep reinvesting your dividends. If you're living off your dividend income, then of course you can't reinvest everything. But if you're not retired and want to continue to grow your income, leave it on for as long as you're able. By now you understand the importance of dividend growth, initial yield, and dividend reinvestment on your total yield on cost. But how do we find companies that will actually grow their dividends consistently? Fundamentally, this is a question about dividend safety, and dividend safety is analyzed by looking at three things: perpetual increase streak, payout ratios, and income growth. In general, you want to look for companies with long increase streaks. A perpetual increase streak of 10 years or more demonstrates a commitment to shareholder returns from dividends, and the business knows its shareholders will expect an increase every year. Since the board of directors knows investors will sell off if they cut the dividend, a company with a long streak is more likely to grow its dividend to avoid a massive share price drop. The payout ratio is the percentage of earnings a stock pays out in dividends. A payout ratio over 100% indicates a business is paying out more than it's earning, which means a dividend cut could be imminent. In general, payout ratios under 75% are considered safe, but high payout ratios for some businesses, like REITs and MLPs, can be expected since they need to pay out most of their earnings for tax purposes. Lastly, income growth can help ensure the safety of the dividend. If a business is making less money year after year, it's impossible for them to continue to raise their dividend. Eventually, the dividend amount will catch up with their declining income and the payout ratio will pop up over 100%. At that point, it's only a matter of time before the dividend is cut. Most companies don't prioritize shareholder returns through dividends, so at first it can seem difficult to separate the wheat from the chaff. Fortunately, there are many resources available to help you find companies that have a long history of raising their dividend and have even calculated the dividend growth rates for you. One of the best resources out there is Dividend Radar, which tracks the dividend increase streaks of all stocks on US exchanges. The holy grail of dividend analysis is a stock that has a high initial yield, high dividend growth, high income growth, and low payout ratios. That's what we dig for on this channel every day. Most weeks, there's at least one stock that hits most of the marks, but every so often a stock will drop, the yield will spike, and buying becomes a no-brainer. If you want to stay up to date and know about these companies as it happens, hit the subscribe button and turn on notifications. Till next time, stay safe and take it easy.